Here's something you may not know. Every mentor we have on our team is practicing IBC. That is a requirement. The infinite banking concept isn't something that you can just talk about, something you can just teach. It's something you actually have to do. You have to walk the walk before you can talk the talk. And that's what we're going to get into today on this episode of Solving the Money Problem with Mike Samitt. His journey is very unique, and I think you're going to love this. All right, Mike, so tell me a little bit about how you found the infinite banking concepts.
Sure. I was in his stock options mastermind group. Someone had mentioned, hey, you guys should check out infinite banking concepts. Really very compelling. So I did my own research. I didn't click on their link, just kind of went out. I found Dave Ramsey bashing the concept. I knew that he said some inaccuracies. So I did some more research on YouTube. I found you and Brent Kessler bashing Dave Ramsey. I'm like, these guys make sense. So I set up a call with Brent. This was May of 2022. Now, I knew I was uninsurable. I had prostate cancer diagnosed in 2019, but wife healthy as could be. So first policies on her. 2 months later, I sold a property, had money for a dump in, and a second policy on my wife.
And let me just clarify that for the audience with the dump in. So all a dump in is excess premium deposits that are made into the policy to get the policy off to a really fast start.
Yeah, really turbocharges the policy. So immediately, probably 20 days later, took a policy loan, put it into a private lending deal, which I still have today. And I'm like, this is too easy. But it became real at that point. My first policy never took a policy loan yet. I was just injecting $5,000 a month. So just kind of letting it build. And then I'm like, I've got to get another policy. So I got a third policy on my wife, maxed out her body. So she has so much death benefit, she sleeps with one eye open. I took a little bit of a break at that point. Then I insured my 3 stepsons. I had insurable interest with my wife's cousin who owns a bar restaurant. So I loaned her money. So insured her. All the agents knew I was uninsurable, looking for more policies, more branches of my banking system. So I bought 2 policies from people. Finally insurable now. Had a prostatectomy in 2023. Got my first policy on my body January of 25. So they're charging an extra fee due to the cancer history. $12 per 1,000 of coverage for 5 years, which comes to $15,800.04 a year. Sounds like a lot of money. I don't really care. This is such a valuable asset. Well worth it. As you always say, Chris, cost is only an issue in the absence of value. These things are chock full of value. And if I waited 5 years for that fee to drop off, I'll be 64, could very well be uninsurable for another reason. So that's why I went ahead and did it. That's now my 11th policy. I now have 4 policies on my wife. So she's happy that I'm trying to even things out a little bit.
Yeah. Now, the human life value you mentioned on Lori, all that is the insurance companies will put a value on our life. And I know that sounds morbid, but par for the course, right? The insurance companies will look at our income, they'll look at our assets, and they'll project it forward. And they have a calculation they'll do, which will basically put that max number for the death benefit. And that is called human life value. So you would hit her human life value. But the one thing I think that's important for all of you listening to know is human life value is a moving target. Because if you make more money, if you gain more assets, which all these policies count as family assets, as household assets, you're increasing that human life value. But the sleeping with one eye open thing is probably very real. So it is good that you're leveling that out. And I love that you went to the point where you started buying other people's policies, people that had policies that maybe no longer could continue them, but they didn't want to just surrender it. So they ended up selling it to you, which allows you to maintain the policy on their life, continue to build their policies. And there's a huge advantage because you get over that efficiency point. If you buy a policy a few years old, that policy is now already compounding. And it's closing the gap on, you hitting that point where every dollar you put in, you can take more out. Now, there's another thing I want to really hit on here is back to the beginning. You had mentioned Dave Ramsey. Now, most of the people listening know Dave Ramsey, love him, hate him. I've always liked Dave Ramsey because I think he does do a good job of solving a problem for people that are in debt. helping them with very simple baby steps is what he calls it, ways to get out of debt. But Dave Ramsey also takes a hard stance on whole life, but he treats all whole life exactly the same. Do you want to talk a little bit about when you listen to Dave Ramsey talk about the infinite banking concept and all the negatives that were surrounded? What were the things that you found at that stage before you really knew about the infinite banking concept? What was it that he was saying that just didn't seem to make sense?
Yeah, he was claiming that Prudential is a mutual company. And I'm like, wait, I owned Prudential stock years ago. So that was one inaccuracy. And just several other things. There's just such a hard stance. Oh, whole life is terrible. Having life insurance is terrible. Again, I had term. I was taught the same stuff. Buy term, invest the rest. I still had my term policy knowing it was uninsurable and knowing that's running out really, really soon. So it was very unsettling knowing I'm going to be uninsurable and without insurance in a couple years. So for him to bash permanent insurance, he's doing his people a disservice, I think, because he's always saying overpriced. But how can you downgrade something that you're going to have the rest of your life? Cancer, no matter what, you're going to have this policy the rest of your life. Term is going to end in 10, 20, 30 years. So insurance companies win 98% of the time because they only pay out about 2% of the time because they insure us when we're young and healthy and don't need it. So again, I hate that it's black or white with Dave Ramsey. Like you said, he does help a lot of people, that tough love, people in debt. You shouldn't even see the inside of the restaurant until you're out of debt. You can forget about a vacation. So he does help a lot of people, but it's his way or no way.
I always like to refer Dave Ramsey to that of someone who finds a bird that hit their window, that broke its wing, and they take the bird and they put it in a cage, they feed it, they give it water, they care for it, they mend its wing, and over time that bird in the cage heals. And its wing is better, and then it's ready to fly. And Dave Ramsey, being the person who mended the wing and fed the bird and put it in the cage and all this, Dave, at the end, when the bird is ready to go fly free again, is very thankful of what Dave did for them, but Dave doesn't want to let it out of the cage anymore. So once Dave gets you in his cage and his ecosystem, he doesn't want to let you out. And one of the interesting things that you had mentioned and that Dave talks heavily about is he's a big buy term invest the difference. And I'm not saying buy term invest the difference isn't a good strategy, especially for his target audience, which is typically people that are buried in debt, living paycheck to paycheck. And I'll be clear, those people typically at that stage in their financial life are not a fit for the infinite banking concepts. They're not able to save money. So Dave is right in helping them get out of that position where they're paycheck to paycheck, buried in debt. But eventually, when they are out of that position, buy term invest the difference, although a good strategy for their debts and things that they wanted to protect, once they're out of debt, they've got a guarantee that policy will end. Where the other side of the coin, and we can talk about specially designed whole life, we can talk about regular whole life, but there isn't a whole life policy, not one, that doesn't hit a point where in your cash value builds to a point where you literally have all the money in cash value that you paid into the policy. We would call that the break even. So think about that, Larry. Over the course of X amount of years, the policies we design are anywhere usually between 7 and actually it could be as low as 5 to 10 years. That's your break-even point. So you make premium deposits. Notice how I didn't say premium payments, because what we're doing, we're building banking systems, and you make deposits into a bank. But these deposits are made into these specially designed whole life policies, which would be premium deposits. So you're making premium deposits into the policy, and you hit a point where all the premium you've paid in, you now, when you look at your statement or your cash value, you have just as much cash value as what you paid in. So at that point, I guess, Mike, I'd like to hear you, because this is that mindset shift, and we're going to move into that. The biggest issue we find with the people we talk to is shifting their mindset, shifting around many false beliefs that they have. And one of those false beliefs is that whole life is expensive, okay? But let's define expensive. The term policy, which is, quote, unquote, Dave's word, cheap, okay? It's affordable, it's cheap. So if you pay into a term policy for 10, 20, 30 years, but you paid cheaper premiums, your premium per month or per year was less than what the whole life is, but you continue to pay. And, the good news is you don't die during that 10, 20, or 30 year period, and your policy ends. Like, take that, and is that cheap or is that expensive? Because to me, that's the most expensive life insurance. And based on that, the commission rates on term policies are, in some cases, many cases, higher. Like the payout on commissions is higher on a term policy than it would be on a whole life policy. Like, what does that tell you?
Yeah. Term is more expensive than whole life. You're renting insurance, so you have nothing. It's all gone, totally gone. All that money's gone.
And I think people understand the rent versus own scenario. Like, owning your mortgage might be more than a rent payment. I don't know if that's so much true anymore, but it might be. But over time, you build equity in your house, which makes your house valuable, which makes it an asset, and you got equity. You don't ever have equity when you rent. Like, that money's gone. Same thing with term. You never have any money in term. It's just gone. But the whole life policy, depending on where that break-even point is, you get all the money back. And then every day after that break-even point, guaranteed, you are guaranteed to have more money than what you paid into the policy. No ifs, no ands, or no buts about it. So to me, that's the cheapest life insurance. As R. Nelson Nash, the author of Becoming Your Own Banker, would say, how much did whole life cost? Nothing. Because you got all the money back in cash value. And I think that's a huge hurdle people need to overcome. Mike, you have gone from being the client, from learning about the infinite banking concepts in a stock options mastermind, to then implementing the infinite banking concepts in your life, taking out the first policy on your wife and then several others, and they all heard that story, and using the funds to go out and earn more money, to do private lending and loans on, who was it that you made a loan to for their business?
Yeah, my wife's cousin.
Your wife's cousin. And so you are, to the nth degree, I guess is a word, you are the banker. You are your own private banker. And you're not just using it in your own life, you're now doing what a bank would do and lending money to other people. So in all of this, you've learned all these traits, and now you are a money mentor, okay? And you are out there showing other people how to do the same thing. Now, what are the biggest things? Because you talk to hundreds of people, okay, about their scenario, who are just coming around to the infinite banking concept, much like you were. They either see a video, watch a YouTube video, whatever it might be. And what are these conversations you're having with these clients? What are they like in the beginning?
Skeptical. Again, you see some random guy in YouTube, and but they're hurting financially. They're on this hamster wheel. What they've been taught, not working. I mean, less than 5% of the people can retire comfortably in the wealthiest nation of all time. So what they've been taught is not working, but people are comfortable in what they're doing. So just changing their mindset, getting them to rethink their thinking is probably the biggest hurdle. Even though things aren't working, they're comfortable making the minimum payments on their 29% credit card. And just getting over the fact to thinking this as a bill. So if they're putting $500 a month in, they're looking at it as a utility bill, where it's a deposit. That's what we call them, deposits into your bank. That then you can take a policy loan, not withdrawing your money stays in there compounding and growing the same way it would if you didn't take that policy loan. Taking that policy loan out and then start hammering down that debt. So they just have trouble getting over that shift where their money goes first, because this is something haven't been taught. But what they're doing currently is not working. So getting over that shift, a spouse is a big hurdle. They're not on board. I've had a husband and wife literally yelling at each other with me on the phone as well. I'm like, you want to just put me on hold for a bit? You guys can work this out? I feel like a marriage counselor, or their CPA, financial advisor. Oh, whole life, just the Dave Ramsey, it's expensive. Fees. Well, we cut our fees drastically. Chris, you always say we give so you get. That's the reason I'm on the phone, because this has worked so well in my life. Such an efficient use of money. So earning money in two places at the same time, there's nothing like it. out there, making money in policy and in my private lending or my mineral rights, wherever I'm investing. That's exclusively how I use my policy. Fortunate enough to never have debt. I was always taught to, if you can't afford it, don't buy it. And I lived beneath my means. So there is that money, that variance between income and expenses to put into the policy. But now the money is multiplying, hence the name of the company, Money Multiplier. Earning money in the policy and in the investment at the same time. There's nothing like it.
Man, that was very well said. And that is one of the biggest things is the mindset. That mindset hurdle of going from looking at, because a lot of the folks that we meet, they look at it like term insurance or like any other insurance, which is a bill. It legitimately is. When you make a term insurance premium payment, it is a payment. It is a bill. That money's gone from your family forever. But those same people love making deposits in their bank account. It feels good. They get a dopamine hit. They know that's their money. Like, that's what we're doing here. The way we design and engineer these policies, and I do want to hit on that in a second, the way we design and engineer them gives you have immediate access to part of your cash value in the first 30 days. So like, that isn't the same as writing a check for a term insurance policy or a homeowner's insurance policy or a car insurance payment. Those are all payments. Here, you're making premium deposits in a policy where you have immediate liquidity of some of the cash value, and anywhere between 60 and 90%, depending on how we design the policy. I mean, that is a drastic difference, but it is a difference in mindset. You have to understand that, and you have to stop looking at it as a bill, because it's not. And if you're, and I've seen this all the time, Mike, I'm sure you have too. A client understands the concept, they watch the videos, they get around the campfire, they're there, they get started. Time goes by, people get in their ear, and their mind drifts back to the old way of thinking, oh, this is a payment. Like I can't afford this, blah, blah, blah. And when people say that to me, I'm like, wait. You're telling me you can't afford to save money? Is that what you're saying? Oh, no. I can't afford these premiums. Yeah, same question. Again, I'm going to ask you, you can't afford to save money, because that's exactly what you're doing with the money you put into your policy. You're saving money. So by you saying you can't afford that, you are telling me you can't afford to save money, which is a whole different problem than where we started in the beginning, because we started with you wanted to be out of debt, you wanted to do this, you wanted to do that. All of these things are solved using your own banking system, using the infinite banking concepts. And not even that, we've created software. Mike, I know you use this on all your calls, software called the Vault, which mathematically proves that this system works far more efficient than the way that most people try to pay off debt or finance cars or whatever they're trying to do. Like, let's just take a quick second and unpack that and also talk about your use of the Vault.
Before we get into that, I changed one word. I get to make my premium deposits, not I have to make my premium deposits. I can't wait till they draft money from my checking account and put it into my bank. That means more interest, more dividends, higher cash value, more I can pull out to put into private lending, mineral rights to make more money. I think 6 of my 11 I am depositing monthly. So you have that option, monthly, quarterly, semi-annually, or annually. Most of my clients choose monthly because it just lines up with their cash flow. They get paid every other week or twice a month. But the Vault is an amazing software tool to determine which method would work best to eliminate the debt: snowball, avalanche, or cash flow index. Now, it's no fault of America necessarily. These credit card companies suck you in with 0% for 12, 18 months. Run up that balance. They think they can pay it off. No one can. And then they charge whatever the hell they want, usually 29%. So much interest is going to these banks. And they just feel helpless, these clients. So this tool will map out everything. I mean, you got to have a plan. If you don't have I can't get anywhere without GPS maps or whatever. I mean, how are you going to get there? And people just randomly throw a little bit of money, minimum payments, maybe an extra few dollars here and there. But this thing will spell it out. Let's just say avalanche method is highest interest to lowest. So we're going to take that policy loan, put everything we can to that first one on that list, and then we'll make the minimum all the rest. But the amount of time you'll save, so if you just continue to make the minimum payments, let's say it will take 3 years to eliminate the debt. But using one of these preferred methods that the Vault suggests could take 2 years. That's great. 2 years, you have no debt, but you have no money either. But then adding in the policy, Taking the policy loan and knocking down the debt might be, let's say, a year and a half to knock out your debt and pay back your policy loan. Now you have no debt, but you have this big pool of money sitting in your policy in cash value, plus the death benefit you've had all along and that you will have the rest of your life. Incredible tool. Clients love it. And it gives them some accountability just to follow this plan.
Wow, very well said. Now, I know a lot of the people you talk to as a mentor, they're in that scenario where they're in debt. They're trying to find a faster, more efficient way out of debt. Maybe they've tried the Dave Ramsey way, and then they come across the video and they're like, wait, maybe this is a better way to go. And you get them on the phone. But you also, I'm sure, actually I know for a fact, you have clients that you get on the call with that are very much like where you were in the beginning, where they don't have debt, that's not their primary concern, but maybe they've got more sophisticated needs and goals of what they're trying to do. Maybe they want to fund their own business. Maybe they want to fund somebody else's business. Maybe they want to do private lending or investment strategies like options trading. Like, how is it when you get those clients on the phone, like, how does that feel? And let's talk a little bit about those experiences.
Yeah, those, I feel like they're my brother or my sister talking to these people because I've been, in the same position. So I get really excited about that. Well, all my clients I love, as long as you're nice and respectful. Yeah, once again, it's just changing one step. So before they just put the money into an investment or their business, a lot of business owners who, I think the reason being they value control. My favorite word to describe this concept is control. So business owners are probably control freaks in most cases, and they don't want to do business with banks. Horrible situation, relying on a bank for anything. Time and, as Nelson Nash calls them all, snakes and dragons. But to eliminate them, totally get rid of the traditional bank, somebody's going to have to go from a bank to the insurance company and policy loans from the insurance company to our traditional bank. But we don't have to store money there, and we don't have to borrow money from them. So personally, I keep a little bit of money in a traditional bank, just like 1 month's expenses. If I have to Venmo my kids money or bail a friend out of jail, which I haven't had to do yet in my life, I guess I need more exciting friends. But I keep about 5 months' expenses sitting in cash value for more bigger emergencies. So it has so many uses, infinite banking, infinite number of things you can use it for. So it's my emergency money. But then anything above and beyond that 5 months' expenses, I am taking that out and putting it to work for me. So that's how but I teach the people that are in my situation as well. So you want to get that money out there working for you to really multiply your wealth.
I think you said something there that really kind of rings true for me. I've been doing this so long, and you've been doing it for quite a while, that, you get so used to being your own private banker, right? Having your own banking system, that what you keep trying to do is increase your capacity for your banking system. And I know, like, I take my salary and that funds my premium deposits and funds my living expenses. But then, if I get bonuses, if I have a windfall because I sell a property like you did to fund your one, like, it's not even a thought for me. The money goes into a traditional bank. And literally, like, I feel like a sense of massive urgency to get the money out of their bank into my bank. And that's how I think about it. I'm thinking the longer I leave my money, this windfall, bonus, whatever, sit in their bank, the bank is making 400 to 1,300% more than I am. They're winning because my money is working for them. And that isn't what I spent all this time, energy, and effort to do, is to make the bank more. So it's like a rush for me to get the money out of their bank and transition it over to my bank. And the beautiful thing, and you're witnessing this now, is as you add policies, when your capacity need increases. And capacity need is just, when we design a policy, folks, I want to be clear about this. We're going to design the policy to meet your needs today. Maybe you want to save $10,000. Maybe you want to save $20,000. Maybe you want to save $500 a month in your policy. We're going to build it, but that is the capacity. You cannot put more than what we build the policy to hold into it, because we built it for your needs today. So over time, when those needs get settled, or your income goes up, or you have a windfall, your capacity need increases. You can't put any more money in that first policy, so you start a second. You start a third. And as Mike said, the second policy, right? He sold that property, had a profit of 300, wanted more capacity. Started policy number 2, or branch office, just like a bank, branch office number 2. And as I've done this and built and built and built, and my capacity has increased. And folks, my scenario, Mike's scenario, any of our mentors' scenario are no different than yours. Like, we all started at one level, usually a much, much lower level. And over time, not by any luck or anything else, life happened. We made more money. We had more opportunities. And our private banking system, which we started with that first policy, has then created more efficiencies and more capacity in our lives. So as you add policies, here's the cool thing. Now, when I have a windfall of money come in, which right now we're selling a property, we're going to have a windfall, okay, of money coming in, much like you did, Mike. I'm going to have to figure out where that money goes. So when I look at my premium deposits, I'm maxing them all out. Could I start another policy? Yeah, the next policy would be on my wife for sure. Or what I can do, because all my money's out there working all the time, I can take this windfall, I can pay the loans down, which is like me instantly earning whatever it was that I was paying in interest to the insurance company. So if the insurance company is charging me 5% simple interest on the loans that I have out there. Now, that's fine that they charge me 5% because my money's out there working at a rate higher than 5%. So I'm making a spread like a bank. But I know if I've got this money sitting in someone else's bank, if I just move it over and pay the loans back to the insurance company, 100% of that money I just repaid to the insurance company for repaying my loan becomes available to me. So I lose zero liquidity. So it's no different than me keeping it in the traditional bank. In my bank, it's the same. But I earn whatever that interest rate is. If it's 5%, that's like me earning a guaranteed 5% on top. And this is where it gets real fun because some of you don't get excited about 5%. Okay. But on top of the 5% that I just earned back because I'm not paying the insurance company that 5%, I'm still earning the dividends. I'm still earning the guaranteed interest. And I've done enough videos, and Mike, you've talked about it all the time, of how much my policies earn. Most people would hear what we earn on a cash-on-cash return and say that's impossible or that's too good to be true. It's just math. Do you have those aha moments when you get your statements and you do the math on the statement and you're like, holy crap, I can't believe how much money I made on this.
Yeah, and these things get better every single day. Today's better than yesterday. Tomorrow's better than today. So my oldest policies are now hitting 4 years old, looking really, really good. You know, you put in $1, you can take out more than $1. So again, pretty soon, put in $1, take out $3. It just gets better all the time.
And I want to just finish with this. When you're talking about your policies and the policies that you do for your clients, like how important is the design and engineering of that policy? Like, you know, a lot of people watch videos and they're like, oh, 90-10, 90% paid up additions, 10% base, 80-20. How important is that factor for the people listening?
Well, we like to customize it for the needs, but as long as it's a specially designed and engineered whole life policy from a mutual company that pays dividends, you're golden. So whether it's a 60-40, 70-30, 80-20, it's going to be great. Now we can, nail it down so it's perfect for you, and that's what we do, depending on your needs.
I love that. And one step further on that, folks, we keep talking about the Vault software, and you can check the Vault out by going to BYOB.vault.com. You can do a free trial. We'll put it up in the description. But the Vault allows us to the ability mathematically to design a policy for you or design a couple policies for you to solve your problem, but it will tell us which policy design is the most efficient for your individual needs. So when Mike were to design another policy for himself, he can run it into the Vault, compare it with other policies, and say, this one's the most efficient. And a lot of times what we find, especially in scenarios where a person is putting excess premium deposits in the beginning, that dump in, especially when they're doing that 90-10 thing just doesn't work. It is not the most efficient. So don't think that just because you watch some guru out there saying this is the ultimate design, this is the best design, it may very well not be the best design for you because your scenario is different than that person's scenario, which is different from another person's scenario. Every client's needs and goals are unique to them. So every policy design, every solution to the problem is different. And that's what you need to understand. And Mike, I bet you any money, if we were to look at all your different policies, none of them are identical to the other one.
You're correct, because they have a different either premium, dump in, or split. Yeah, they're all very different. And of course, two policies I brought from people, and they're with different mutually owned companies as well. So I have 4 with Lafayette Life, I have 5 with One America, I have 1 with Mass, and 1 with Security Mutual.
I love that. It's diversification, right? You're not just diversifying policy designs, in terms of how they're designed and engineered. You're diversifying across multiple insurance carriers. Not that there's really any risk that these insurance carriers ever go insolvent. They've been around for hundreds of years, perfect track histories, never missed dividend payments. But it is smart because each company has its own strength. And like everybody that's listening to this, when they invest money or they put money out in various things, you don't just own one investment, right? You don't have I hope you don't have all your money in one company stock. You have a diversified portfolio. And if you have a financial advisor, your advisor's job is to create a diversified portfolio. Well, with us, when we're creating these private banking systems, we also want to diversify. We want to diversify carriers. We want to diversify the way the policy is designed. That makes you so much stronger from a standpoint of building your own private banking system, because each policy is operating for a specific use. And then as that use evolves or as your needs evolve, the policy takes on new shapes of life. It really does. I love that. So Mike, as we kind of close this solving the money problem, is there any advice you would give to anyone who watches this video?
Yeah, get started. Again, I wish I would have known about this 30 years ago. No one told me about it. I had great financial advisors, CPAs, although I was probably too young and stupid to take action back then. But it's not a get rich quick thing. It's a get wealthy and stay wealthy for generations thing. It just takes a little time for that compounding to work its magic, but it is guaranteed to happen. It can do nothing but go up. So the sooner you get started, the better to get that compounding clock going.
Well, the final thing I'm going to say is the other day, I had the honor, and it really was an honor, to do a podcast with one of the gentlemen who was partnered with the heirs to the Hilton hotel chain. This gentleman operates Hilton Wealth. The name is all you need to know. Hilton Wealth is a family office. I asked this gentleman on this podcast, his name's Mark Miller, I said, how many of your clients have whole life insurance policy? And he kind of laughed. And he says, well, all of them. And these are some of the wealthiest families. I mean, you literally can't just work with their family office. You have to be brought in. You have to be, referred in. It's kind of like that kind of a club. And most family offices are. They also have another division, Hilton Wealth, in its tax and wealth division. They work with a different group of clients, but even on that side, he mentioned they all do. And it was kind of a laughing thing because he was kind of thinking, the way he answered it was kind of like, well, duh, they all do. And it's funny because you're talking about these wealthy families and all of them have whole life insurance. All of them are using it in their own lives. All of them are using it for their own banking. He brought up the Rockefellers and he said that's how they built their wealth. But yet when we talk to people that are the Dave Ramsey folks, not to pick on Dave Ramsey, but I'll just kind of segment that, the lower end, like they think that whole life is expensive and the worst place you can put your money. So there's this massive disconnect between the wealthy and, I'm not going to say the rest of the folks, but the people who just believe the Dave Ramsey model. There's a huge divide. And you have to pick and choose on what side you want to be. And, if whatever you believe, whatever you dream, whatever you say you are. That's it. Okay? So if you want to be wealthy, start living and doing what the wealthy do. If you want to stay stuck where you're at, if you want to keep thinking with a scarcity mindset, rice and beans, then beans and rice, and don't spend money, never take on any debt, pay off your house, live happily and be content and do as you're told, then that's exactly where you're going to stay. So most people, and maybe some of you watching this, you just need to decide, what do you want to be? What do you want to do? What life do you want to live? And then live it. And live the same way the wealthy do, if that's what you want. So Mike, thank you so very much for joining us on this episode of Solving the Money Problem. Your story is amazing. Continue going out there and solving other people's problems, and your problems will keep getting solved.
Yeah, it's been my pleasure.
All right, folks, thanks for joining us in this episode. And if you like this one, I'm going to put this video up right here, The Secrets of the Wealthy. You want to learn what the infinite banking concepts is, this is where it starts. We'll see you on the next one.